Selling options is the closest thing I know to printing money. It's like getting a big fat dividend on steroids. So why aren't most people like you catching on to this? If I had to think about it and come up with one reason, it's fear. You're probably scared of the unknown, worried about what happens when an option goes sideways, and you've got to manage the position. And that's totally cool because we have all been there. And today, I'm going to be showing you how to handle it just like a pro. Picture this. I've got a $392,000 position on SoFi cash secured puts, and it's absolutely underwater. It looks like a losing trade, right? But I'm cool as a cucumber. I'm not sweating it at all. Why? Because I'm using something called rolling and wheeling to turn this into a winning trade. And in this video, I'm going to be breaking it all down, exactly how I managed that $392,000 loser and pulled in over $12,000 in premium last week. Yep, I collected $11,675 from rolling the trade and another $390 from wheeling it. Boom, a 5-figure payday from a so-called losing position. Imagine that for yourself, right? I want you to actually close your eyes and think about it for yourself. Have you ever made a monthly paycheck just from managing a losing trade? Drop your experience in the comments down below. I'd really like to hear it. I'm betting this is something you'd want to learn to jumpstart your own retirement or supplement that 9-to-5 grind. So let's get right into it. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on a unique 3-part approach: the multi-bagger for asset accumulation and appreciation, the dividend machine for high-yield, consistent distributions to cover your bills, and the options income strategy to accelerate passive income with covered calls and cash secured puts to fund your retirement in style. If you want to learn how I did it, stick around and you'll see exactly how to retire early like I did. Last week on Tuesday, I started breaking down how I manage underwater trades. I told you that I'd like to wait until Wednesday to make my move because I was expecting a market shift, specifically a dovish Jerome Powell speech, and that could shake things up. And guess what? I absolutely nailed it. The market moved just like I thought, and today I'm showing you exactly what I did, how I did it, and the actual cost basis of shares I bought, especially for those underwater plays you need to manage. If you missed that video, no worries whatsoever. Just click on the link up above for a quick reference, and after you're done with that one, come right back to this video. But first, real quick, let's recap what selling an option is. When you sell a covered call, you own the shares, then you're saying, I'll sell these shares at a certain price by a certain date. Or if you sell a put, you don't own the shares and you're saying, I'll buy these shares at a certain price by a certain date. And in both cases, the buyer pays you a premium for that contract. And that premium, it's like a dividend on steroids. Now, here's a key thing to remember, which I'll get into a lot more detail a little bit later in this video, so don't go anywhere. But your cost basis is not just the strike price of the contract, what you agreed to buy or sell the shares at, which might sound counterintuitive. It's actually the strike price minus all of the premiums you collected so far, and that's huge for tracking your real position and your real cost basis. Okay, great. Now we're all caught up on the basics. Let me get into the good stuff. How I personally managed this nearly $400,000 trade and turned it around, so stick with me. This is going to sound kind of confusing at first, but it's actually pretty simple. Following along with the screenshots that I'm putting up on the screen, and make sure you look at the arrows, which is going to be pointing at exactly what I'm talking about. So let's start breaking this down. I usually sell my option contracts about 1 month out. For me, my trading month starts in the middle of the month, not in the beginning like a calendar month. So back in February, I kicked off my trades. On February 20th, I opened 200 cash secured puts on SoFi. These were set up for a March 21st expiration, or last Friday, with a strike price of $14. For that, I collected 48 cents per contract. And since each contract covers 100 shares, that's $9,600 in premium. Boom, first move, done. Then on February 21st, I did the same exact play, 200 more cash secured puts, same exact strike, same expiration, and collected another 48 cents per contract. That's another $9,600 in my pocket. Now on top of that, I already had 80 SoFi contracts from earlier with a $13 strike. I rolled these up to match the $14 strike, and for that roll, I collected an extra 23 cents per contract. Oh, and a quick note, that's a roll. Originally, back in January, I already collected 38 cents on those contracts already, which was another $3,040. So let's add it up really fast. $9,600 from the first batch, $9,600 from the second batch, $1,840 from the roll, and $3,040 from the earlier premiums. That's a cool total collected $24,080 across the 280 contracts for SoFi. Now my collateral for this is 280 contracts times 100 shares per contract times $14 strike price, which comes out to a $392,000 collateral position. For anyone doing the math, that's roughly 6.14% return in premiums against my collateral in roughly this 1 month period. That's not too shabby, right? For context, SoFi was trading at $15 at the time, roughly, plus or minus. So this was all in play while the stock was way above my strike price. See, it sounds like a lot, but it's very straightforward. And when you follow the screenshots, keep your eyes on the arrows. And let's move on to what happened next. If you need to go back and watch again, that's cool, but I'm moving on without you. I'm going to talk about rolling, and I'm going to talk about wheeling. All right, here's where it gets really, really juicy. Follow me close, literally. Follow me very, very close, because I'm going to break it down on how I manage those 280 contracts. Of those, I rolled 267 contracts. The other 13 got assigned. Don't worry if this sounds tricky. Just keep your eyes on the screen and watch the arrows. They'll point you to the right track. I'm not sweating my $392,000 in collateral one bit, and you'll see why. First, let's talk about rolling. Rolling is when you got an existing contract with some value, aka the premium, and you close it out to open up a new contract, or you roll it into a new contract. Get it? Rolling, rolling, rolling. Ideally, that new contract, right? So you have your existing contract, you have the new contract. Ideally, the new contract has a higher premium so that you can pocket the difference. And this is called a net positive premium collected in the rolling of a contract. For the 267 contracts that I rolled, I pushed them out 1 month to April 17th. Keeping the same exact $14 strike. Now, when I do my rolls, there's going to be a bid and there's going to be an ask price. You don't have to take the price that they give you right away. You can request a price. So I like to be greedy at first to try to get as high as possible, and sometimes it works out. I aim for the high end of the bid-ask spread. So as soon as the market opened, I put in this trade right here. I try to get 30 cents per contract. That didn't work out. A few hours later, I dropped it to 27 cents a contract, and that still didn't work out. It didn't fill. Finally, I set it to 25 cents, and bam, it went through. That roll netted me $11,675 for those 267 contracts. Quick note, on Robinhood, you could only buy, sell, or roll 200 contracts at a time, so you'll see a split into 3 different batches on the screenshots. 2 for 200 contracts and 1 for 67 contracts. So please pay close attention. It's all laid out. Now on to the 13 contracts that got assigned. That's 1,300 shares total. Let me explain the assignment really quick. Usually, contracts don't get assigned until the last or second to last day of expiration. But the buyer, the one that paid you the premium, can assign them anytime the contracts are in the money. For a cash secured put, that's when the share price dips below the strike price. And for a cash secured put, that is when the share price dips below the strike price. So I got assigned early, Tuesday or Wednesday morning, no big deal whatsoever. Here's where the wheel strategy kicks in. With the wheel, once your cash secured puts get assigned, it's all good, it's Gucci, don't worry about it because you're going to be a seasoned vet very soon like myself. You now own the shares. I paid for those 1,300 SoFi shares, and instead of just sitting on them and doing nothing, crying like a little biatch, I turned around and sold covered calls to generate even more premiums, funding my retirement lifestyle. In your case, it could be funding your retirement lifestyle or supplementing your 9-to-5 income. We are all at different points in life, some higher, some lower, some on the same exact level. The main point is that you're learning, and I'm showing you exactly how I do this, full transparency. This is when the wheel is actually in action. This is why it's called the wheel strategy. Cash secured puts get assigned, you do a covered call. Covered calls get assigned, you do a cash secured put over and over and over again. For these, I sold a covered call expiring April 17th with the same $14 strike price and collected 30 cents per contract or $390 for those 1,300 shares. So between rolling the 267 contracts for $11,675 and wheeling the remaining 1,300 assigned shares for $390, I'm still raking in cash while managing this position. See how calm I am with a $392,000 collateral? It's all about the strategy. Follow the screenshots and let's keep going. Let's talk about cost basis and strategy because this is extremely important. I told you earlier I was going to talk about this. I hope that you actually stuck around and did yourself a favor because you are shooting yourself in the foot if you are not watching at this particular point in time. Now that you've got the basics down, you know what selling options is, you know how to roll options and how to wheel an option. So with rolling and wheeling locked in, let's talk about what I'm really paying for these shares. Time to dive into the values and cost basis. Over the weekend, I was coaching one of my students, walking them through some positions for this coming week, and we hit on a killer lesson about cost basis. Here's the deal. When your cash secured puts get assigned and you buy the shares, it might seem like your cost basis is just the strike price. Nope, that's 100% wrong. The real way to calculate your cost basis is the strike price minus all of the premiums collected collectively. Let's break it down with an example. For my 280 SoFi contracts, let's make the math really easy. Say I originally collected 50 cents per contract in premium. That's my initial haul. Then I rolled 267 contracts for 25 cents each, and then I wheeled the 13 assigned contracts for another 30 cents, but let's just use 25 cents here just to make all the math jive and make it very, very simple. So what's my actual cost basis? You got your original $14, that's the strike price, minus the 50 cents from the initial premium collected, minus another 25 cents from the rolling and the wheel premiums. That brings my true cost basis to $13.25 per share. Think about that. I don't need SoFi to hit $14 by expiration to break even or win. I just need it above $13.25 and I'm golden, I'm Gucci, I'm straight. Now imagine a month from now, SoFi is trading between $12 and $13.50. I'd roll these contracts again, collect another 25 to 60 cents in premium, drag my cost basis even lower, and I keep doing this, cannibalizing the cost basis through premium accumulation until I manufacture the win. I've rolled contracts for 6 months straight before, even closer to a year, and sometimes I bank net premium in some months, and some months I'm just breaking even Steven more or less, but I keep rolling. Eventually, I'm coming out on top. That's how you build experience with these. I honestly don't even remember a trade where I lost that. It might have happened, and I'm sure it does happen, but the chances and odds are actually in your favor, not against your favor. And worst case scenario, you buy the shares at the cost basis that you have, and you have shares. It's not like you lose all of your money like when you're buying options. That's how you build experience with this. But here's the catch. You can get in trouble. If SoFi tanks to say $10 or lower, I wouldn't be able to roll or break even for a net premium. I'd have to take a loss. As a rule of thumb, if the stock is within 20% of your strike, you're usually okay to manage it. Preferably, I would like to be at that 15% or less, and ideally, I would like to be at around 10% of my strike. And then you'll still snag a decent premium. So at 15, 20%, you'll break even, make a little bit. At 10%, you're going to be collecting a really good premium, similar to what I collected on these rolls. And if it's just a few percent off, like it's really close to the strike price, you're actually probably going to be collecting more premium in the roll than you did on the initial selling of the option. I did that literally last week with a Robinhood $44 strike. I rolled it when it was $42.50. I collected more money on my roll than my initial play. Heads up, I'm not a technical advisor. I do coach some students and share what I know. But this isn't financial advice. Definitely talk to a pro before jumping in. If you enjoyed this, smash that like button and drop a comment if you got questions. I'd love to hear from you. Oh, and if selling options isn't your thing, no worries, I definitely got you. Check out the video up above. It's Goldman Sachs covered call dividend ETF paying an 11% yield. It does all the heavy lifting, selling their own options so you don't have to. Let's keep it rolling. Peace.